Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. The true break below the lower bull channel line of the second bull channel 3 weeks ago, which is highlighted in bright red on my daily chart, and the subsequent confirmed break below the declining long moving average, currently at 1460, that same week, was the total finish to the bullish incentive that started back from the break up and out of late 2022 ascending triangle in November last year. I asked a question 2 weeks ago and also postulated some possible answers at the same time. Thus, and I quote, "The question now is what will be next?" Now, you may say that all this action since October is part of an ascending inverted scallop pattern, or you may say it's part of a bump and run reversal top pattern, and in both cases I'd agree. There are elements of both of these patterns here, but not enough to say it is one or the other. Hence, I choose to look at the longer term charts to see if I could gain a clue as to what will be next, end of quote. Looking at these longer term charts provoked the following comments, and I quote, "The possibility that we now had a February 2021 to date bear flag. This has set up the opportunity. It would very much depend now upon two factors," end of quote. Looking back again at the more recent action, I expanded on this, and I quote, "Will the market halt at the congestion at 1378 that had formed the lower trend line of the descending triangle from late last year? And if not, will it halt at the July 22 low at 1304? If the answer is no to both, then we may well have a bear flag formation, with potential down as far as the 1120 zone. Quite a big move if it does come about," end of quote. Well, 2 weeks ago we had an initial indication that the market was not happy about heading below the base of the old descending triangle from late last year, as the reaction move back up made 2 Fridays ago with a bullish harami showed. This move back up accelerated within a fairly free area till prices reached the 50% Fibonacci line of December 2020 to February 22 move at 1451, where they hesitated last week. I value this 50% Fibonacci line as a support and resistance level, but I thought last week a potential larger force was now moving down to not only impinge on the market, but also to reinforce this 50% Fibonacci line. This was the declining long moving average, currently at 1460, the one that had been broken 3 weeks prior to the market's way on the market's way down. However, when the market reached both these two resistances last Friday, it sliced through them, heading lower like a knife through butter. It was left to the next resistance, one I mentioned last week, and even the one beyond that, to stop this move lower. These were the flatlining medium moving average, currently at 1487, to slow it down, and the slowly declining short medium moving average, currently 1496, to stop it, which it did this past Monday. Since then, prices have slowly edged lower, but not as far as to test the declining long moving average, or the 50% Fibonacci line below that. If a decline is to be effective, then these two are the levels to watch out for on the downside, despite them not performing that well in recent days. Meanwhile, looking at the top side, just keep a wary eye on the short medium moving average and its declines, plus the 2014 high at 1522, and above all else the 50% Fibonacci line at 1532 of the February 2022 to July 2022 move. Now, for one final note, I am not a personal follower of Gartley analysis, mainly because I've not had the time to study it properly. However, I'm minded to look at the action from July 22 to date as having elements of a possible Gartley butterfly pattern. I will just leave that hanging here for the moment. Chicago soybean meal. I feel obliged to start this commentary not in my usual way, but to at least notice the elephant in the room, and that is that we had a monthly key reversal down here last month. Now, I'm sorry, I know I'm repeating myself here again, but the situation deserves repetition. You see, for months now, we've had different patterns, not so much melding in with each other, but rather crashing in and out of each other. The bigger pattern here is the May to date seemingly broken, then repaired, ascending, expanding wedge pattern. A huge pattern that I had pointed out many months ago. This had developed for a while, but is now looking pretty ill. It was never a perfect pattern by any means, but it had seemed to work until the end of last year. To assist in seeing this pattern, I've highlighted it in dark blue. It's worth noting that the lower trend line is also the neckline of the huge December 2021 to June 22 move, the head and shoulders continuation pattern, currently at 420 even. I am still thinking about downgrading it, as there's enough else going on nearby that deserves some closer and better attention. Now, the next pattern to look at are the ones that caused the peak of the market in early and late December last year. It was a combination of the 2021 high at 471.40, inflamed, yes, I do think that is a good word to describe it, inflamed by the neckline, which I highlighted in bright red, of the February to April 2022 head and shoulders top, currently at 482.70. I should perhaps clarify that the June 2014 high at 479.30 had also helped in this matter. The climb we've seen started from an attempt higher up and away from this neckline at the beginning of March, but fresh resistances such as the 2022 high at 491.5 and the 2014 high at 494.40 capped that rise. The market breached both of these resistances but was not able to break them and fell away in the middle of March. It was the combined key reversal down and bearish engulfing pattern made 4 Mondays ago that really started to move lower, enough that we saw prices create a monthly key reversal down for March. The base of the fall, where it finally stopped, was the rising long moving average below, and that's currently 438.20, from which we saw last week a strong move higher. This rally has petered out last week, though the final cut was done by, of all things, the declining short moving average, currently at 454.5, and that was done this week. This past Tuesday saw prices punch down through the medium moving average and halt temporarily at some recently formed congestion between 453 and 454, before yesterday resuming the decline. Below we now have the combination of the April 2021 high at 439.30 and the rising long moving average. Now remember, this long moving average turned the market back down in March, helped by the April 2021 high and a congestion highs from January and February 2021, all in the 433.5 zone. I said further last week, and I quote, "In the immediate short term, this leads me to think that perhaps we may be starting to form a trading range between the long moving average below and the medium moving average above, though I am not wedded to that idea as yet." And the only gave the thought of it, of a possible bear flag or a bearish halfway hesitation being built, a passing glance. No, for the bigger picture, I will look again at the longer term charts, as I did last week. I said here 2 weeks ago, and I quote again, "Here we can see the potential monthly key reversal down, but also the possibility for a double top formed over Q4 2021 to date. On this one, it will depend on what the market does once it comes into close proximity to the 50% Fibonacci line for this move at 403.60, should it get down to those levels." And that's the end of the quote. Back now to the more recent view, and you can see that whilst the potential range trading between the medium long moving averages mentioned earlier is important, in the big picture, the old neckline come lower trend line, currently at 420 even, of the ascending expanding wedge pattern may be more important, especially if the nascent idea of a bear flag type action grows in any significance. Then of course there is the support of the 50% Fibonacci line at 403.60 in amongst the congestion that stretches from 415.5 down to the 400 even zone. That level may well be the key to what may happen next. Chicago soybean oil. It is 2 weeks now since we had a weekly key reversal down, and we've still seen a complete lack of follow-through lower. It has been a most disappointing pattern. Going back to the recent key features other than the weekly key reversal, we had the March-based bear flag formation, and in the bigger picture, the break below the lower time, currently at 62.73 of the December 2021 to June 2022 move, the bullish shift pitch for that move, which I've highlighted in dark blue on my daily chart. This lower time halted the decline in mid-December last year. However, by the start of March, the recovery back up had run out of steam and a fresh attempt lower was more successful. This time prices punched down through the 2011 high at 61 even and supports at 59.44, 58.82 to 58.16, inside of which is the August 2011 high at 58.59, plus the September 2012 high at 57.64. For a while, we saw congestion turning the middle time during the middle of March, but last week the fall started again with what turned out to be a completed bear flag pattern formed over March. So all in all, we've very recently formed a small bear flag, fulfilled its potential, and immediately turned back up again. Yet the recovery is now showing signs of wariness as prices reach up to the underside of resistances at the September 2012 high at 57.64, then also the 58.82 to 58.16 area, inside of which is the August 2011 high at 58.59. Meanwhile, looking at the longer term picture, this still has opportunities on the downside. It was, as I said 2 weeks ago, and I quote, "Looking at the longer term picture, and we can see a topping action in formation, though whether it is a lopsided head and shoulders top or a lopsided diamond pattern is still a little open. What we can see is that the 51.10 to 51.20 area is key because of the low from December 2021. Below that, we seem to have a fairly free area until the absolute 50% absolute Fibonacci line at 43.82.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.